The cash budget is going to appear to be a little bit complicated, but in reality, it's quite simple. You're going to take the cash that you start with, and you're going to add in your cash collections. That'll give you the cash that you have available to pay for all of your disbursements. So what did you start with, plus what you received, and then subtract out what you pay, and that will be your ending cash. Sometimes you actually pay more than you have. If you pay more than you have, you're going to have to borrow some money. So we want to make sure that not only do we have enough money to pay for the current month, we want to make sure we have enough money left over to get started for the next month. So we're going to have a minimum amount also. So the cash receipts section lists all the cash inflows, excluding cash that comes from financing. The cash disbursement section consists of all cash payments, excluding repayments of principal and interest. And when you look at the difference between those two, you're either going to have excess cash or you're going to be deficient. If you're deficient, you're going to have to borrow some money to be able to repay funds that were previously borrowed. The financing section details the borrowings and repayments projected to take place. Let's take a look at it. So, assume the following information for Royal. They have a 16% open line of credit, so they can borrow money from a bank at any time at a 16% interest rate. That's an annual rate. Sometimes they'll give you a monthly rate. If the interest rate is like 1 or 2%, it's probably monthly. If it's closer to 10 or higher than 10, it's probably an annual amount. They have to maintain a minimum cash balance of $30,000. So they want to make sure that they don't. We want to make sure they have cash available at the beginning of the next month. So minimum cash balance of $30,000. It's assumed that we borrow on the first day of the month and repay on the last. That's going to help with some of the math for calculating interest. Since they paid a cash dividend of $49,000 in April, we're not going to worry too much about that. That'll be given to us. They purchased some equipment in May, June. That'll be given to us. We're not going to worry too much about that. But they do have a beginning balance of $40,000. Let's take a look at what that looks like. So they started with $40,000, and they collected $170,000. That was from the schedule of expected cash collections. So they're going to have $210,000 available. Pretty simple, just math here. They're going to give you these numbers. The disbursements are going to have to be given to you also. The $40,000 is going to come from the schedule of expected cash disbursements for materials. Direct labor budget I didn't go over, but it's pretty straightforward. Overhead budget I didn't go over, pretty straightforward. Selling and administrative expense budget I didn't go over, it's pretty straightforward. Bottom line is all of these numbers are going to be given to you. So you simply just have to add them up to get your disbursements. So if we have 210 available, but we're going to have to pay 230 in April, remember this is a budget, so we're looking forward. We're going to have a deficiency. We're going to be $20,000 short in April. But don't forget that we also want to have a $30,000 ending balance, so we're going to have to borrow some money. So we're going to be deficient $20,000. We have to have a balance of 30, so we have to borrow 50. So if we're short 20 and we borrow 50, in the end we'll have our $30,000 available. So the ending of April becomes the beginning of May. Add in your cash collections, which will be given to you, total cash available. Add up your disbursements, which will be given to you. And here, look at that. We've got just enough money to pay for May and have $30,000 left over. But we don't have enough money to pay back the $50,000 that we borrowed. So what is the excess deficiency available for June? Pretty simple. Take what you started with in ending May becomes beginning of June. Add your collections, which will be given to you. That's $365,000. Add up your disbursements, which is $270,000. And we're going to have $95,000 left over. Fantastic. We now have enough money to pay the $50,000 and still have $30,000 left over. But wait, we also have to pay interest. We want to make sure we have enough money not just to pay back the principal, but also to pay back the interest. To calculate the interest, you take the amount that you borrowed, the $50,000, times the rate, which is 16%, which is an annual amount. And since it was for 3 months out of the year, so 3 out of 12, you multiply that by 1/4, 3/12, 25%, all the same thing. So 50,000 times 16% times 3/12 is $2,000 of interest. So from that 95, we're going to pay back 50 that we borrowed plus the 2,000 of interest. So our total repayments are going to be 52,000, and we were left with $43,000 in the end.